The average family overpays $2,000 a year on insurance. That is not a guess. That is a fact from the Consumer Federation of America. And here is the craziest part. You have probably never even looked at most of your policies. You just pay the bill every month. Automatic. No questions asked. That stops today. I am going to walk you through a complete insurance audit, step by step, in 1 hour, with a free template you can follow along. The link is in the description. By the time we finish, you will know exactly which coverages to cancel, which discounts you are missing, and how to keep up to $2,000 in your own pocket this year. Grab your phone or laptop. Open your insurance apps or your email folders. Pull up your latest statements. Let us start the clock. Step 1. Auto insurance. Spend 15 minutes here. Open your current car insurance declaration page. That is the summary that shows your coverages and limits. First thing to check is liability coverage. If you have less than $100,000 per person and $300,000 per accident, you are underinsured. But if you have more than $300,000 per person, you are probably overpaying. The sweet spot for most drivers in the US, UK, and Canada is $100,000 per person, $300,000 per accident, and $100,000 for property damage. Write that down. Now, look at collision and comprehensive. These cover damage to your own car. If your car is worth less than $4,000, drop these coverages. Seriously. Insurance companies will only pay out the actual cash value of the car minus your deductible. If your car is older, you are paying premiums for almost no payout. Check your car's value on Kelley Blue Book, Canada Drives, or Auto Trader UK. If it is under $4,000, remove collision and comprehensive today. That alone can save you $300 to $600 a year. Next, look at your deductible. If you have a $500 deductible, ask your agent what the premium would be for $1,000. The difference is often $50 to $100 a year. That is free money if you have an emergency fund. But never raise your deductible if you do not have at least that amount sitting in savings. If you cannot cover a $1,000 hit, stick with $500. Now let us talk about discounts. Most people miss at least 3. Call your insurer or check your online account for these. Multi-vehicle discount, good driver discount, defensive driving course discount, low mileage discount if you drive less than 10,000 miles or 16,000 kilometers a year, and the biggest one, bundling with home or renter's insurance. Bundling saves 15 to 25% on both policies. That is often $300 to $600 a year. One more thing on auto insurance. Have you shopped around in the last 12 months? If not, you are likely overpaying by $300 a year. That is called the loyalty penalty. Insurers raise rates on existing customers but offer lower rates to new ones. Spend 20 minutes getting quotes from 3 competitors. Use the same coverages. Take the lowest quote back to your current insurer and ask them to match it. If they say no, switch. That is the end of step 1. Summary: audit your auto insurance every 12 months. Check liability limits. Drop collision and comp on cheap cars. Raise your deductible if you can afford it. Ask for every discount. Shop around. Never be loyal. Now here is where it gets interesting. Step 2. Homeowners or renters insurance. Spend 15 minutes here. Your home or renter's insurance is probably the most neglected policy you own. You bought it when you moved in, and you have not touched it since. That is a problem because your stuff loses value every year. Open your home insurance declaration page. Look at personal property coverage. That is the amount they will pay for your furniture, electronics, and clothes. Most policies default to 70% of your dwelling coverage. But do you really own $70,000 worth of stuff If you have a $100,000 condo, probably not. Do a rough estimate. Walk through each room in your head. Bedroom, bed, dresser, TV, maybe $3,000. Living room, sofa, coffee table, entertainment center, another $3,000. Kitchen, appliances, dishes, $2,000. Most people are insured for far more than they own. Lowering that coverage from 70% to 50% can save you $100 to $200 per year. Next, look at your deductible. Home insurance deductibles are often $1,000 or $2,000. Raising yours to $2,500 or $5,000 can lower your premium by 10 to 20%. But again, only do this if you have the cash set aside. Now look for exclusions you do not need. Do you have identity theft coverage added? That is usually $10 to $20 a year. Cancel it. Federal law already protects you from fraudulent charges, and free credit monitoring does the rest. Do you have water backup coverage? If you do not have a basement or sump pump, you do not need it. Do you have jewelry or electronics writers for items worth less than $2,000? Self-insure those. Put the premium into a savings account instead. Most homeowners also overpay on replacement cost versus actual cash value. Actual cash value pays you what your old sofa is worth today. Almost nothing. Replacement cost pays for a new sofa. Make sure you have replacement cost on your personal property. That is not where you want to save money. The savings come from lowering your coverage limits to what you actually own, not from switching to actual cash value, now renter's insurance. If you rent, your policy is even cheaper, usually $15 to $20 a month. But the same rules apply. Lower personal property coverage to a realistic number. $10,000 is enough for most single renters. $20,000 for a family. And skip the add-ons like computer coverage. Your laptop is not worth the extra premium, one more hidden discount for homeowners. If you have updated your electrical wiring, plumbing, or roof in the last 10 years, tell your insurer. That can lower your premium by 15%. If you have a home security system or smoke detectors that are monitored, that is another discount. If you have bundled your auto and home, you already got that discount, but ask if they have a loyalty discount for staying with them for 3 years or more. Some do, some do not. You have to ask. Segment 2 summary. Lower your personal property coverage to what you actually own. Raise your deductible if you have savings. Remove useless add-ons like identity theft and small electronics riders. Tell your insurer about home upgrades, and every 2 years shop your home insurance just like you do with auto. Now step 3. Life insurance. Spend 10 minutes here. This one is quick but critical. Open your life insurance policy. Do you have whole life, universal life, or variable life? If yes, and you are not a millionaire, you are almost certainly overpaying. Whole life insurance costs 5 to 10 times more than term life for the same death benefit. The cash value component earns 2 to 4% returns, while you pay high fees and surrender charges. For 95% of people, the better strategy is term life insurance plus investing the difference. Look at your term life policy if you have one. Is it a 20-year term or 30-year term? How much is the death benefit? A good rule of thumb is 10 to 15 times your annual income. If you earn $60,000, you need $600,000 to $900,000 in coverage. If you have less than that, you are underinsured. If you have more than that and no dependents, you are overpaying. Here is a pattern interrupt. Most agents will not tell you. If you have term life insurance through your employer, that is great as a bonus. But do not rely on it as your only coverage. If you leave your job, you lose that insurance. And converting it to an individual policy later will cost 2 to 3 times more because you are older and possibly less healthy. Buy your own term life policy outside of work. It is cheap. A 30-year-old non-smoker can get $500,000 for $20 to $30 a month. If you have whole life and you have had it for less than 10 years, you have a tough decision. The surrender fees are high in the early years, but staying in means paying high premiums for decades. Run the numbers. If you cancel, you get the cash surrender value. Take that money, buy a term life policy, and invest the difference in a low-cost index fund. Over 20 years, you will come out tens of thousands of dollars ahead. If you have had whole life for more than 15 years, you might be past the fee-heavy period. In that case, keep it. But do not buy a new one. Do you have life insurance on your children? Cancel it today. That is the most overpriced product in the industry. The chance of a child dying is extremely low, and the payout is often only $10,000 to $20,000. You are better off putting that premium into a savings account for their future. If you want to protect your family, insure the income earners, not the kids. Segment 3 summary. Avoid whole life unless you are ultra wealthy. Buy term life at 10 to 15 times your income. Do not rely on employer life insurance. Cancel child life insurance. And if you have an old whole life policy, do the math on surrendering. Now, step 4, health and supplemental insurance. Spend 10 minutes here. Open your health insurance policy or look at your employer benefits. Do you have hospital indemnity insurance? That pays a fixed amount per day if you are in the hospital. Most people do not need this. Your major medical health insurance already covers hospital stays. Hospital indemnity pays a few $100s a day, but the premiums add up to $200 to $400 a year. Cancel it unless you have a high deductible health plan and you expect a hospital stay. Do you have critical illness insurance? This pays a lump sum if you get cancer, heart attack, or stroke. If you already have good health insurance and an emergency fund, you do not need this. The payouts are often $10,000 to $30,000, but the premiums are high for older people. If you are under 40 and healthy, skip it. If you have a family history of early cancer, it might make sense. But for most people, it is overpriced. Do you have accident insurance? That pays for broken bones, ER visits, and ambulance rides. Again, your major medical already covers these things. Accident insurance is a duplicate product. The only people who benefit are those in high-risk jobs like construction or logging. If you work at a desk, cancel it. Now look at dental and vision insurance. Do not cancel these if your employer subsidizes them. But if you are buying them on your own, do the math. Dental insurance often has a low annual maximum, like $1,000 to $1,500. If you pay $60 a month, that is $720 a year. 2 cleanings cost $200. You are better off paying cash and putting the rest into a health savings account. Vision insurance is similar, $120 a year for an eye exam and cheap frames. Glasses from online stores cost $60. Pay cash. One more thing. If you have a health savings account, also known as an HSA, you are doing something right. That is the best retirement account nobody talks about, but only if you have a high deductible health plan. If you have a low deductible plan and you are paying higher premiums, you might save money by switching to a high deductible plan and maxing out your HSA. Run the numbers. The premium difference is often $2,000 a year. The HSA gives you triple tax benefits. That is a whole other video. Segment 4 summary. Drop hospital indemnity, critical illness, and accident insurance unless you have special risks. Self-pay for dental and vision if you buy your own. Consider switching to a high deductible plan with an HSA now. Step 5. The final step. Call your agent or use their online chat. Spend 10 minutes on this. You have done the audit. You know what coverages to drop and what discounts to ask for. Now you need to execute. Call each insurer and say these exact words. I want to remove collision and comprehensive from my old car. I want to increase my homeowner deductible to $2,500. I want to lower my personal property coverage to $50,000. I want to apply all available discounts including multi-policy, good driver, low mileage, and home security. Then ask them this question. What is the annual premium after those changes? Write it down, then ask, can you do any better? Often they will find another 5% discount